All right, guys. So here we are. Market is up for another day, rallying. Nasdaq's up 1.1. S&P's up almost 0.9%, and that's good because we have a long bias in the portfolio, but we're just not making the profits to the upside that I thought we would have. And when I started this video, this video blog, I said that this was for self-improvement. So I'm sitting here and I'm wondering, okay, so a lot of positions are up. Yeah, we're making money to the upside. We're up, but not as much. So what am I doing wrong? And I think it comes down to, when I look at the options, right? So options are traded, or they're valued with intrinsic value, with time premium, and implied volatility, right? So if I'm buying an option, it's out of the money, so there's no intrinsic value, and I'm buying some time. I think what's hurting me to the upside, to be honest, is the implied volatility. So I need to find a way, and I was thinking about this today, to try to capture. If I'm going to go long calls, I have to find the options that are giving me an implied volatility that's a reasonable price, right? So if I'm buying these calls, right? So last week we went long calls, and the market has rallied pretty aggressively, but these options aren't quite getting this because the implied volatility is dropping, and that's deteriorating the value of the option. So yeah, there's a problem there, I think. So I made a chart. So I made this implied volatility chart, right? So this is going to show where we are. So let's take a look at, I don't know, SPY. All right, so I plug this in here. It automatically updates. Now what I did here is I went back for a year. I took the 1 year average of the implied volatility, and I took the standard deviation. I did plus one standard deviation and minus one standard deviation of the average. So it can give me here where the SPYs are. So you see the SPYs, here's the average, here's the lower bound, -1, here's the upper bound. So up here, SPY contracts are very expensive. So it wouldn't make sense to write calls, I'm sorry, it wouldn't make sense to buy calls on the SPYs with the implied volatility so high. So I need a way to figure this out. Again, like I said, when I started this, I'm not an expert in options. I'm learning as I go. We're doing well. The trading metrics for the month, you know, I'm up 58,000 on $530,000 deployed, so I'm up 11% for the month. So I'm not complaining, but I think we can do better. So going back to this implied volatility, I feel that when it's up here, when it's north of its 1 standard deviation line in implied volatility, we should be writing, and when it's south of its 1 standard deviation down here, this green line, we should be buying. So I have to keep that in mind when I go forward. I don't know, just a couple of things that I'm talking about here. All right, so let's go over what we did today. So here is GNRC. We went with the bear put vertical. It gapped down big this morning. It's still down 3.2%, but way off its lows. I closed this out this morning. All right, so on May 25th, we had sold the July 15th 200 strike price puts for $9.04, and we had bought the July 15th puts 210 strike price for $12.85. Today we unwound them for about, call it an 8% gain in the trade. Here is Monster Beverage. So we went long the calls. Now it had a great 2 days. It's up today. Yeah, but it's expiring this Friday. So I don't know what the market is going to hold for the rest of the week. So I decided to cut my losses on this one. So here's Monster Beverage. We had, this was on the 27th of May. We had bought the June 24, which is expiring this Friday. So they were coming, I would have held it for a little bit longer if I had more time, but they're expiring Friday. So June 24, $90 strike price calls for $2.59. I sold today for 90 cents. I lost about 65% of the trade. Here's IBM. So IBM really looking nice. It's forming a new uptrend. So here's the 50, here's the 20. The 20 is above the 50. It's been hitting its 50-day support. It hit its 50-day a couple days ago. Today it's rising. It rose yesterday, it rose today. So I'm thinking that this thing is going to trade higher. So I went ahead and I did a bull call vertical on this one. So I went ahead and I sold the August 19th calls, $150 strike price for $1.45, and I bought the August 19th calls, $140 strike price for $4.80, and we'll see where it goes. I think this is going to trend higher. So you can see we have a little bit of work to do with the implied volatility. I have to figure out how to maximize my gains when the market is turning like it is now. Like I said, this blog is just as a self-improvement type of thing, and that's what we're doing. So until tomorrow, I'll see you guys later.